Trump 2.0 offers Fed plenty to think. Indian automakers gear up for the EV revolution, and why Salesforce is my top pick for 2025. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode of the Stock Doctor podcast. Lots to discuss this week as Trump 2.0 really kicks into full gear already, and it's already barely been a week. Inauguration was on 20th, and already there's been plenty of drama and action. This is not a political show, however, so all the opinions, all the opinion that I will raise here will be related to the financial markets, to what investors should think about, and all of that. So just thought I'll start the show by giving you a disclaimer, as I understand sometimes discussing anything related to politics can be a little bit of sensitive area. Now, I did tell you last week that volatility would be the name of the game under Trump 2.0. In fact, I ended the Doctor's Weekly Snapshot segment with that warning. But for now, if you look at the market action that took place last week, the markets seem to be focusing on the positives of the Trump policies rather than any potential negatives. I mean, this was very clear last week as markets scaled new highs and all three indices finished the week once again in green. It's becoming quite a pattern, which is good. Which is good if you're a perma bull like me. Markets finishing, especially when they brush off any sort of negative news that is not necessarily negative, but at the same time, when the markets do finish every week in the green, scaling new highs, obviously there is the question of valuation. Anyway, once the dust settled, for now it's all great news for the bulls. Once the dust settled, the Dow jumped 2.2%. Both the S&P 500 and the tech-heavy Nasdaq jumped 1.7% for the week, and the S&P 500 had a record close. It's the highest close since December 6th. It actually finished around 6,100. So, like I said, optimism is at its peak. When optimism is at its peak, enjoy while you can. Enjoy the gains, enjoy the wins, but also keep an eye out because because the question that should be on your minds is: has the optimism gone too far? The coming week would seriously test this optimism that I'm talking about. Okay, so that is what I want you guys to first of all understand, especially because we have the first Fed meeting of 2025, as well as 4 of the Mag 7 constituents report their Q4 earnings, and that's Microsoft, Alphabet, Meta, and Tesla. So essentially, the AI trade would be under full focus in the coming week, along with the first Fed meeting of 2025. Obviously, that will be next episode's focus, episode 113's focus. This week, I want to take you through some of the policies that President Trump unveiled and talk about whether the inflationary concerns surrounding President Trump's tariff plan is something that both the investors and the Fed need to worry about. In order to do that, let me first take you through the first segment, Doctor's Weekly Snapshot. Now, we're in the Doctor's Weekly Snapshot. Like I said, no breaks in between. All I'm telling you is on the last I'm going to start off the segment by saying that on the last episode, I did mention how the December inflation report came in much better than expected. I also mentioned, however, how President Trump's tariffs could allow inflation to rear its head again, which could lead the Fed to leave rates higher for longer. Economists, according to a very recent Wall Street Journal report, seem to be thinking the same. Now, there was a quarterly survey of economists which the Wall Street Journal conducts, and that was published last week. And it showed that economists actually predict higher inflation and higher interest rates for the next 2 years due to Trump's plans for tariffs, tax cuts, and immigration restrictions. They anticipate that the president's tariffs would have negative effects on economic growth. At the same time, they do anticipate lower taxes and deregulation to offset the pressures from the tariffs. In October last year, so remember this survey is quarterly, yeah. So the most results was obviously from October to December. This the period, what the economists thought for the October-December period. Now the survey obviously that was released last time was in October, so that was the preceding quarter, June to September. So in October last year, when the survey was when the survey results were out, the same panel of economists projected consumer prices to rise to 2.3% in 2025. These same economists now see consumer prices rising 2.7% in 2025. So obviously, inflationary pressures, they do tend to see an uptick in inflation, and they do see inflation to be at much higher rates than previously anticipated. The higher projected inflation over the full year, according to them, would equate to about $600 more in costs on average for the consumer based on the latest data on consumer spending. So the extra 600 in excess is on the consumer wallets. Yes, so consumers would be feeling a pressure of upwards an upward pressure of $600 on average, according to these economists. The latest survey also shows economists raising their inflation forecast for 2026, with CPI now expected to rise to 2.6% at the end of 2025 instead of the 2.3% expected back in October. While this might be seen as a negative sign, one has to factor in that inflation in December stood at 2.9%. So overall, despite the tariff impact, that these economists do expect inflation to head downwards. Obviously, you got to look at the silver lining as well. Not all the news was negative from this particular survey. When it comes to the Fed, economists now expect the Fed to keep interest rates high through 2027, compared to their previous projections. More specifically, the midpoint of the range of the Fed funds rate, which currently stands at 4.375%, is now projected to come down to only 3.89% in 2025, much higher than the October forecast of 3.3. So in October, the economists through the survey said that the Fed rate, that the interest rates would come down from 4.375% today to 3.3%. In the latest survey that was released last week, the results of which was released last week, the projections are now have been bumped up from 3.3% to 3.89%. Now, that's the data. So you see all the data, clearly they're seeing some form of tariff impact, inflationary impact from President Trump's tariff plans. And so they've not only raised the inflation overall in 25 and 26, they've also raised the Fed, they've also raised the interest rate projections as to where interest rates will be at the end of 2025. And that's a 0.6% jump compared to the October survey result. Now, let me give you my take. I gave you the data. Now let me give you my take. First of all, I want you guys to note that these are projections which get revised every single quarter. This is where my volatility is the name of the game comment comes into play. Economist projections can also be volatile, and given President Trump's penchant for surprising everyone, I do expect these projections to keep changing every quarter. In other words, the next survey results that would come back, I'm expecting to see a whole different set of numbers. This is why I said these are projections. Okay. In fact, I anticipate there to be more frequent revisions in this through this survey than when Biden was the president. Such is the fluidity with which President Trump governs. We all know this. We all knew this even before the elections, and we all knew this even in the build up to the inauguration, and now we're seeing it play out. So this cannot be surprising if you have been a US investor and if you've been looking at the various projections and keep going up and down depending on what President Trump says. I mean, it is the fluidity is exactly through which President Trump governs. So I would take these latest projections with a lot of salt, not just a pinch of salt, a lot of salt. Secondly, if you actually do look at the projections, sure, they say that inflation is expected to be higher than previously anticipated, but the difference between the October projections and the January projections are not exactly what I would say alarming. And with respect to the Fed cuts, the projections aren't even surprising, especially since the Fed clearly mentioned that they would be doing fewer cuts in 2025 than previously announced. This announcement was made in December meeting, and that's 2 months after the October survey. So again, in my opinion, investors shouldn't make their investment decisions purely based on these projections. Like I said, I do expect frequent revisions. By the time we see this again in April, I'm expecting numbers to be revised again. Okay, whatever President Trump says, whatever tariffs situations raised, all of that, economists would change their projections just like that. Okay, so I would treat this as noise. Okay, I wouldn't go solely. I wouldn't solely base my investment decision making based on these projections that keep getting revised every quarter. If there is one area, however, that both the Fed and investors should be looking at is to identify the direction of inflation. It's the latest trend involving food prices, which are threatening to rise again. External shocks such as bird flu outbreaks and extreme weather events have contributed to the rising food prices in the US. The spread of bird flu has significantly impacted poultry and egg production, leading to reduced supply and higher prices. This has created a ripple effect across related food products, which actually have strained household budgets. What's worse is that the rising prices are disproportionately affecting lower income households that spend a larger share of their income on groceries. Consumers, as a result, are shifting their purchasing habits by opting for cheaper alternatives or cutting back on non essential items to manage their budgets. While some of these price pressures are likely to ease as supply chains stabilize and weather conditions improve, structural challenges such as climate change and geopolitical tensions could lead to a sustained volatility in food prices, and that's something that investors and the Fed should seriously consider. In fact, that should these food prices, the data surrounding food prices should not be consumed with any salt. Take it as they are, because that actually could alter the direction of inflation and could actually put upward pressure on inflation. Don't go by the projections, go by what's actually happening. Another area that the Fed and investors should be particularly concerned about is whether the Fed's independence itself is once again under threat. This is based on the latest comments from President Trump, where he highlighted how he would like to see rates come down a lot. Not my words, his words, come down a lot, and implied that steps to keep a lid on price pressures were an important precursor to lower interest rates. He also claimed that he expects his administration to reduce energy prices, drill baby drill, which would make it possible to keep inflation under check, thereby subsequently bringing down interest rates. It is very clear that despite appointing him back in 2018, President Trump is not a fan of Fed Chair Jerome Powell. In his latest comments, he repeated his long-standing view that he understands interest rate policy better than the Fed and its chair, Jerome Powell. His words, not mine, were, "If I disagree, I will let it be known." Again, this can't be surprising to you. Okay, this can't be surprising to you, coming from a president whose penchant is to surprise people. Okay, so you you have to expect the unexpected. Volatility is the name of the game. Come on, guys. But however, you got to take it into serious consideration. Is the Fed's independence really under threat? If you ask me, and I'm strictly apolitical, and I'm just saying my comments strictly on apolitical scenario, I don't see the Fed's independence coming under any immediate threat, despite the latest comments from President Trump. As far as I'm concerned, there is no issue in any president, Biden, Trump, Obama, I don't care who it is at the White House, letting his opinion known. Several senators, including the Democratic ones, such as Senator Elizabeth Warren, have publicly vilified Fed Chair Jerome Powell in the past and has constantly put indirect pressure on him to cut rates through Senate hearings. Moreover, Trump's nominee to serve as Treasury Secretary, Scott Bessent, already told lawmakers at his confirmation hearing last week that he believed the central bank should remain independent from White House interference on its monetary policy decisions. As such, I would still put the threat of Fed losing its independence as minimum at this point. Of course, this can change in the blink of an eye. Probably you'll hear me say something else different next week or the week after. I don't know. But right now, I do see the Fed threat as, the threat of Fed losing its independence is minimum, and I couldn't care less what what President Trump has to say. He's free. He's a free man. He can express his opinion any way he seems fit. Other senators from the opposite party have done it. Presidents in the past have done it. I just don't see that as a direct correlation to Fed losing its independence. For me, the biggest factor that investors should factor in addition to the food prices that I was talking about, is President Trump's plans for tariffs. At the World Economic Forum in Davos last week, President Trump said that he intends to follow through on the America First campaign promises, spurning allies in the process if necessary. His words, again, his quote is, "My message to every business in the world is very simple. Come make your product in America and we will give you among the lowest taxes of any nation on planet Earth," Trump said in a video address from Washington on Thursday, revealing he didn't attend it in person because of his inauguration earlier this week. He further went on to say, "But if you don't make your product in America, which is your prerogative, then very simply, you will have to pay a tariff." At the same time that he's uttering these words at World Economic Forum and so on and so forth, he also used the threat of imposing stiff tariffs on goods from Canada and Mexico as soon as next week to pressure the two nations to renegotiate the USMCA deal. These examples suggest that although tariffs are a negotiating tactic, President Trump is more likely than not to go ahead with imposing tariffs if required. And this, ladies and gentlemen, is what you guys should, as investors, should take on board seriously, as it could seriously spike up inflation again. Bottom line, the Fed has a lot to think in the coming weeks and months as it gears up for its first meeting of 2025 in the coming week. While all signs indicate that it could pause its rate cutting cycle next week, the more important matter is how it would navigate President Trump's tariffs policies. At the same time, it would also be wise for the Fed to keep an eye on mortgage rates as well, which topped 7% last week. Elevated mortgage rates caused US home sales in 2024 to fall to its lowest level in nearly 30 years. Home prices have continued rising on a year over year basis because the inventory of homes for sales is lower than historically normal levels. Inventory is up from year ago levels, but supply remains tight in many markets because many would be sellers with low mortgage rates are simply unwilling to sell and take on a high rate to buy a different home. Rising home prices as a consequence of all these events are also another matter that the Fed should seriously factor in. As for investors, things like economist projections and the threat of Fed losing its independence currently shouldn't matter. Their focus and this is my opinion, feel free to disagree. Yeah, that's completely up to you, obviously. Again, like I said, I'm feel free to express my opinion on the show. Take it or leave it. That's up to you guys. All right. Their focus, investors' focus, as far as I'm concerned, must be solely on the actual data and what Chair Powell has to say next week, which has so far been a massive positive for the markets. The focus must be solely on the actual data and what Chair Powell has to say next week. What Chair Powell has to say next week is not the positive. What has been positive for the markets has been the Q4 earnings season, another factor that investors should consider. Last week, over 80% of the companies that reported earnings delivered EPS beats. The stakes, however, are going to get higher in the coming week as the MAG 7 constituents start reporting, and we get some detailed insights into how the trajectory of the AI revolution is shaping up. A combination of Fed Chair press conference, MAG 7 earnings, and President Trump's tariff policies is what would determine the fate of the markets this week and beyond. And to be fair, these three things are the things that really should matter for investors, not the political commentary about Fed's independence, and certainly not some not so important economic projections. On that note, let's go to the next segment, Doctor Goes Home, where we go from US to India. Right. In the Doctor Goes Home segment, essentially in India, I'd like to talk to you again about some of the automakers. Yeah. First things first, though, before I move into the detailed theme of this week's segment, first things first, just a quick reminder that the first budget of Modi 3.0 government will be unveiled on Saturday, the Feb 1st. Another thing to keep in mind is that the upcoming week will be a 6-day trading week as stock exchanges will be holding a special full day trading session on Saturday. Of course, next week's episode, episode 113, no surprises, will feature my take on the budget and what it could mean for investors. This week, though, as promised to you before, I'm going to discuss what transpired during the Bharat Mobility Expo 2025, which took place from Jan 17th to Jan 22nd. And of course, the implications of the event for Indian auto investors. First things first, the Expo was a spectacular success, in my opinion, as over 90 new models and 80 auto components were launched. The event also attracted significant international participation from Germany, the UK, South Korea, Japan, and Mexico, and attracted nearly 9 lakh visitors. But if one were to ask what the major highlight of the expo was, then in my opinion, it would be that it actually demonstrated that Indian automakers are pivoting to EVs and that years from now, investors can point to this expo that just took place as a major turning point for India's EV revolution. I say this because all the notable launches from the expo were EV models. India's auto leader Maruti Suzuki unveiled its e-Vitara. The second biggest car maker Hyundai Motor unveiled its Creta Electric. Kia unveiled an upgraded model of its electric SUV EV6, and EV leader Tata Motors Tamo launched a slew of EV models, including the Harrier EV, the new Tiago EV, and even a brand new concept car dubbed the Avinya X, which will use the company's new EV-only platform that will be shared with models from Jaguar Land Rover. EV leader hopeful Mahindra & Mahindra, as I mentioned in an earlier episode, presented its latest EV launches, the XEV 9e and the BE6. Just to let you know, these models I just mentioned are the tip of the iceberg. Yeah, you had Mercedes Benz, Skoda Auto, and many other models launching their many other automakers also launching their EV models and other ICE models as well. Now, auto executives have become majorly bullish on India's EV revolution in recent weeks. They believe that the entry of more players and the new product launches will reduce consumer confusion and boost confidence in the EV technology. They believe that this is expected to accelerate the market growth and the ecosystem development. Executives from the likes of Mercedes Benz, Tamo, and Mahindra also stressed that they see 2025 as the beginning of significant EV penetration with expectations for rapid growth over the next 2 to 3 years. Now, it's not just automakers, auto executives who are saying this. Forecasts and projections also confirm this to be the case. There was an article that was published recently on Economic Times which actually talked about this anticipated growth in the EV space, and it also cited significant increase in EV launches and industry optimism as key factors driving the said growth. EVs, according to this particular article, are projected to account for over 50% of the incremental sales this year, doubling their share in total car sales to 4%. I wanted to keep this in mind, guys. India still has one of the lowest EV penetrations compared to some of the peer countries, so the growth potential is simply massive. Yeah. Furthermore, companies such as Maruti Suzuki are investing heavily in fast charging networks and local battery production to make EVs more accessible and affordable. Government incentives like a reduced GST rate and expanding charging infrastructure are also expected to facilitate the growth. There was also a report by Nomura published actually yesterday. Today is Sunday. It was published Saturday. Go check it out. I would urge you to check the report out, which actually said that EV penetration in India is expected to surge to 5% by FY27 and 9% by FY30 after remaining stagnant at around 2% for the past 2 years. For electric two wheelers, Nomura projects that penetration is forecasted to grow from 5.8% in FY25 to 10% by FY27, and get this, 20% by FY30. TVS Motor executives at Davos, the World Economic Forum, actually hinted at this growth, projecting EVs to account for about 30% of the company's volumes in the coming 2 years. Now, Nomura attributes the surge in EV penetration to two key factors. You have enhanced industry focus, which I already talked about, and technological advancements such as integrated solutions for EV components and premium features that would enhance both efficiency and affordability. And it's not just the top automakers that are investing in launching new EV models. Even the luxury EV space is expected to show signs of growth. Rising disposable income and economic growth are expected to drive demand in this space too, and the government is well aware of this. As such, the government is actually set to provide incentives for local manufacturing of high end EVs under the Scheme for Manufacturing Electric Cars. It's called SMEC or SMEC. According to the SMEC scheme, should automakers invest at least $500 million, which comes around 4,300 crores, in a greenfield EV factory within 3 years, then they would receive concessional import duties. Now, this should boost the EV sales of the likes of Mercedes Benz, especially as high end EVs, which are categorized as something that priced above 25 lakhs, currently represent a very small market in India. So, one thing is very clear: Indian automakers, through their launches at the Bharat Mobility Expo, clearly have placed the bets on the expected surge in Indian consumers' appetite for EVs. In my opinion, however, the private sector investment alone cannot be the only factor that would drive the EV penetration. The government simply has to play its parts, and this is why next week's budget is extremely critical as far as the EV penetration and the EV revolution is concerned. Automakers have a lot of expectations from the budget, but to me, these are very realistic expectations and something that FM Nirmala Sitharaman should seriously consider allocating funds for. These include simplified taxation, battery technology and energy storage, charging infrastructure expansion, and boosting domestic manufacturing through streamlined GST frameworks. I honestly don't see this as anything but realistic. I do think these are very, very, very realistic demands. And simply, if you if you put all this together, then you will understand that all the industry, the auto industry, all it seeks is policy clarity, streamlined processes, and targeted incentives to foster sustainable growth in the EV sector. What's so wrong with that? I really don't think the ask is big, and I do believe that the government must provide the necessary funding towards these areas for India's EV revolution to truly take off. The Bharat Mobility Electric Expo gave auto investors a blueprint of the top players' plans for the future. And it is very clear, ladies and gentlemen, that while looking at the companies to invest, EV penetration and EV strategy has to be a bigger factor than before for investors to incorporate and for investors to base their decision making upon. The question now is, will the government offer the necessary incentives to really turbocharge this penetration? Next Saturday, February 1st, will hopefully give us the answers. With that, let's head to the final segment, Dr. Dissects. Right, this week on the Dr. Dissect segment, yet another software player and yet another AI beneficiary comes under the microscope. I'll be dissecting, ladies and gentlemen, Salesforce, ticker symbol CRM. I've been very critical about this company and its management in the recent past. Okay, I'm going to start off by saying that. Okay, this is because there was a lot of talk about potential, how we're going to, how we're going to revolutionize AI and how the company is going to use AI and become a major beneficiary of AI. Blah 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 blah. Absolutely nothing tangible to show for it. Hence, I think my criticism well worth it. However, I'm one to say when things change, I will change my opinion with it as long as there is enough facts, not opinion, as long as there are some facts to back the change of stance. And so my stance changed when the company launched its third quarter, when the company reported its third quarter last month, and when the company launched its flagship AI tool called Agentforce. After a lot of doubt surrounding the earnings potential of AI in the enterprise software world, a lot of the companies in the sector are starting to see this potential translate into actual growth. And Salesforce has certainly been one of the biggest beneficiaries of the shift. The company during the first quarter launched Agentforce, which are AI-powered virtual agents that are designed to enhance support for both customers and employees. Unlike traditional chatbots, these AI agents operate independently, relying on companies' data to make decisions and complete tasks without human involvement. There was a lot of excitement, as usual, from Salesforce CEO, billionaire Mark Benioff, during the earnings call about Agentforce. Now, listen, this is a man who has a penchant for, who's a fantastic orator. Okay, let me tell you, he's got a great future in politics. But to be honest, I used to take it with a pinch of salt, but I used to follow his understanding a lot more. By the way, I am a Salesforce investor. I have a very small position in the company, and I am a fan of Mark Benioff. It's just the fact that recently, in the recent past, I felt like it was more of like meandering, like blabbing, rather than something tangible. But so there was I approached the earnings call with a lot of skepticism. Okay, however, unlike past quarters, this excitement was finally backed by data. More specifically, Mr. Benioff announced that during the earnings call that within a week of its launch, the company had already signed 200 Agentforce deals, and the clients included the likes of FedEx, Adecco, Accenture, and IBM. And he said that the pipeline for Agentforce remains robust going into the fourth quarter. And unlike traditional AI agents, given that Agentforce is trained on up to 300 petabytes of data that Salesforce manages, Google or use your own AI ChatGPT or something to look at how many zeros petabytes have. You'll come in for a shock, by the way. The degree of hallucination is expected to be very low for its AI agent compared to its peers, which should help the company, in my opinion, attract more customers. The quality and the breadth of data available to Salesforce is also set to become more enhanced thanks to the company's recent acquisition of Zoomin. Zoomin is a leading provider for unstructured data, and given that unstructured data is essentially the fuel for large language models, this acquisition should further enhance the quality of Salesforce's AI agents and further reduce the agent's degree of hallucination. Moreover, the company also acquired another company called Own, which should allow Salesforce to strengthen data security, privacy, and compliance, yet another key area that potential enterprise AI customers seek out in their AI agents. Furthermore, last month, the company also launched Agentforce 2.0, which the company plans to roll out next month. The, the second version of Agentforce comes with workflow integrations that allow for more effective customization as well as the ability to seamlessly connect with Slack, Tableau, and MuleSoft. Agentforce 2.0 will also be equipped with advanced reasoning and retrieval augmented generation (RAG). I'm not going to go into the technical details, it's not a computer science show. But I am going to say that it is equipped with advanced reasoning and the RAG via the company's Atlas reasoning engine, which makes the new version of Agentforce more accurate and more sophisticated than the previous version. The higher degree of accuracy, thanks to RAG, and the higher number of integrations should make it easier for Salesforce to pitch Agentforce to customers. And Agentforce 2.0 is coming in at the right time. According to Precedence Research, the enterprise AI market is expected to grow from $14.5 billion in 2024 to approximately 560.7 billion by 2034, so in a decade, which translates to a CAGR during this period of a whopping 44.1%. Given the tremendous demand seen for Agentforce 1, the advanced features of Agentforce 2 should place, in my opinion, Salesforce in a very strong position to capitalize on this exponential growth and seize a significant chunk of the enterprise AI market. The whole reason why investors have been hyper bullish on the AI revolution has been due to its potential to transform industries and unlock productivity. At the start of this year, at the start of 2024 of this year, at the start of 2024, I did say there were major question marks regarding the speed with which this transformation will happen due to AI. Investors certainly questioned the company's massive capex spend when it became very apparent that the AI revolution might take longer to transpire. However, towards the end of 2024, the productivity gains really started to be very clear among enterprises thanks to the rise of something called digital labor. With Agentforce 2.0, however, those gains are expected to see an exponential growth, which makes Salesforce, in my opinion, the number one beneficiary of the enterprise AI revolution today. Now, I take a piece of paper. Pen can only mean one thing. It's valuation time. So let's talk valuation. Salesforce, according to LSEG data, currently trades at a forward price to earnings. So I'm going to put Salesforce CRM. Forward price to earnings currently is about 31 times. Okay. It's in line with Microsoft, which also trades at about 31.2, but significantly cheaper than the likes of Snowflake, which has a forward price to earnings of 174.5, and ServiceNow 65.4. Relative to its historical multiple, the stock currently trades around the midpoint of its 2-year forward price to earnings median, which is 26.4, and its 5-year forward price to earnings multiple, which is 34.7. Given the potential of Agentforce and the fact that it is already gaining significant traction among the company's clients, as evidenced by the fact that it had already signed 200 Agentforce deals within 1 week of its launch, in my opinion, the company deserves a higher multiple than where it's currently trading at. As such, I've actually assumed, okay, so I'm going to scratch. So I wrote forward price to earnings of 31. I'm going to scratch that, and my projections, projected my projected forward price to earnings multiple is 34.7, and this is much higher than my previous estimate of 27 times. So projected PE 34.7x. Management during the Q3 earnings call said that they now expect full year FY25 non-GAAP EPS to come in between $9.98 and $10.03. The midpoint of the guidance falls short of the consensus of $10.11. The company, however, if you look at the historical performance, it has exceeded analyst full year estimates in the EPS estimates in the last 5 years. The magnitude of the beat on average has been 3.58%. In line with the past, assuming the company beats the FY25 analyst EPS estimate of $10.11 by 3.58%, then the projected FY25 EPS would be $10.47, which is what I've assumed for my calculation. So you have $10.47 as my projected FY25 EPS. Now, according to Seeking Alpha, The company currently trades at a forward PEG ratio, so price to earnings to growth ratio of 2.19, in line with its 5-year average. At this ratio, and assuming a forward price to earnings multiple of 34.7, as mentioned earlier, the FY26 earnings growth, FY26 earnings growth FY26 earnings growth would be 15.8%, would be 15.8%. FY26 earnings growth would be 15.8%, in line with its long-term average growth according to LSEG data. As such, I have assumed this earnings growth for my calculations, which would result in an FY26 projected EPS FY26 projected EPS of $12.12, higher than my previous estimate of 11.20. So $12.12 is what I'm projecting the EPS to come in at for FY26. So you have 34.7, which is my projected PE multiple, 12.12, which is my projected EPS. Multiply that, guys, and you get an updated price target, a new price target of $421. $421 is my price target, a significant increase from my previous price target of 302. The difference from 302 to 421 can be attributed to the additional growth that I factored in on account of the impressive traction seen for Agentforce, which I believe to be a game changer for the company in the enterprise AI arms race, so to speak. So I'm maintaining my buy rating on the stock. By the way, the upside from current levels is about 26%. So buy rating, upside of 26%, updated price target $421. Every time I give you a buy rating, a buy stock, a stock to buy, stock to consider investing in, I talk about the risk factor. The high stock-based compensation continues to be a concern for me as far as Salesforce is concerned and remains a risk to my bull case. It jumped 18.3% in the most recent quarter and came in at 8.7% of the revenue. Management during the earnings call announced that the FY25 full-year stock-based compensation would be about 8.4% of the full-year revenue. Until they bring this ratios down significantly, it should be a cause for concern for investors, in my opinion. The other risk factor, obviously, to my bull case is the uncertainty surrounding the traction of Agentforce. For now, demand remains very, very strong, and there is every reason to remain bullish on the potential of Salesforce's flagship AI tool. However, should the long-term demand weaken for whatever reason, it would be a hit to the long-term growth of the company. Obviously, I would have to revise my growth projections downward, which would subsequently affect my price target and my bull case. Bottom line, despite a mixed quarter, Salesforce's stock jumped nearly 11% post its earnings performance, and that is all down to its latest AI offering, Agentforce. The company launched the AI agent in Q3 and within a week managed to sign 200 deals involving this agent. Moreover, last month, towards the end of 24, the company launched Agentforce 2.0, which is equipped with the company's Atlas reasoning engine that has RAG capability, retrieval augmented generation capabilities, thereby enhancing the accuracy of the AI agent. The company's acquisitions of both Zoomin and Own Group are also expected to enhance the quality of the data on which Agentforce would be trained, as well as enhance the privacy and data security. All key factors that should position Salesforce to capture a significant chunk of the growth in enterprise AI. Finally, given that AI Agentforce 2.0 is integrated with the likes of Tableau, MuleSoft, and more importantly, Slack, it allows the Salesforce to pitch the AI agent as part of the entire Salesforce platform. I don't recall any other company which is currently capable of platformization of its AI tools, which puts Salesforce in a unique position. From a valuation perspective, there is considerable upside from current levels. As I said, it's about 26% upside. Price target 421, rating buy. Salesforce CEO Mark Benioff couldn't resist taking a shot at rival Microsoft during the earnings call. And while in the past I've considered this to be a completely unnecessary gimmick, when I look at the growth potential of Agentforce, due to the reasons that I've just talked about in this segment, I am of the opinion that the dig is certainly backed by substance. Agentforce, especially its latest version, is also the reason why I'm making Salesforce as my top stock pick for 2025. That's all the time I have for you this week. If you have a specific Indian or US stock suggestion, for the doctor to diagnose or dissect, do tweet me Eruthamvina, UTHAMVINAY, or email me on the Stock Doctor Podcast at gmail.com. Thank you once again for listening, guys. And I will see you next week. Remember, 6-day trading session in India. Budget launched Feb 1st. You will have the first Fed meeting of 2025 next week. All of this and more will be covered in the next episode. So until then, stay safe and make some money.